All right, ladies and gentlemen, investors and traders alike. My name is Seth Golden. This is Finom Group, and this is our weekly State of the Market. Thank you for tuning in every Thursday. This week, I have a special guest with me, one of our Finom Group members, Hernan, coming all the way from
Argentina.
See, we're international like that. As you can see on your screen here from the graphics, sorry we are on strike. And it certainly feels that way when it comes to any buying activity here in 2022. You probably already heard the term, there's a buyer strike. And that certainly is what it feels like given the consistent waterfall type price action in the market. So again, welcome to our State of the Market. We're going to dive right into things, kind of see where, some of the data might be heading in the near future, as well as over the next 12 months. As I like to do, I like to start off with, some quotes and just some thoughtful phrases. This one is from Douglas Bonaparte. Bears from 2009 to 2021. A crash is coming every month of every year from 2009 to 2021. The bears in 2022. I told you so. So it only took a good 12, 13 years if we exonerate the COVID crash, which was for all of a month. Here's one from yours truly. Nobody knows precisely where markets will land. Nobody knows why it will precisely land where it will, when it does. Nobody knows and behaves according to what they know inside their portfolio. Doubt is universal. Skill is not. So no matter what anybody knows, understands, their education, their experience in the market, it doesn't mean they're not going to make mistakes. It doesn't mean that they're impervious to errors in their portfolio. We all know this, that, and the other, and sometimes we can still get caught off sides by the market, but nobody knows what's going to happen tomorrow. It kind of puts us all on a level playing field, if you will. All right, so Hernan, this is your first time on Weekly State of the Market. I'm sure you got a bunch of questions, but
yeah.
What might be your top question right now, given market conditions and the economic backdrop, the whole macro economic cycle?
Okay, thank you, Seth. And hello, everyone. So far, corporate earnings are not being affected so much by inflation. Guidance is being maintained by the majority of the companies. Also, consumer spending is still very, very strong. Mm-hmm. However, stock market is a forward-looking mechanism. Right. So my question to you is, do you think this price action could be an indication of future worsening conditions to both corporate earnings and consumer spending?
Yeah, I'm sure that the market is trying to get out in front of, whatever the majority of investors are thinking lay ahead for the economy and, how that feeds through to corporate earnings. But, while the market, as you aptly stated, while the market is a forward discounting mechanism, it doesn't mean it always discounts appropriately. It doesn't mean it always is perfectly predictive of future earnings or economic cycles. There's another saying by Philip Samuel, I think it is, that the stock market has accurately predicted 9 of the last 5 recessions. In other words, it's corrected or went into a technical bear market 9 times, but only of those 9 times was 5 times there was a recession. So the market, we can be of the opinion that it's a forward discounting mechanism, and that generally holds true, but it doesn't mean it's a precision discounting mechanism. So it can get it wrong. And, to some degree right now, the most market participants are saying that the last 20 months or so was wrong. So it's taken it all back. Or a goodly portion of it, that's for darn sure. All right, good question. That's a great way to lead into things. So kind of looking at some of our studies here, You would think 5 down weeks in a row for the S&P 500 and for the NASDAQ, that we should be due for a bounce and, possibly a really, significant rally. These are all the occasions that we've been down 5 weeks in a row. And usually, unfortunately, the 6th week in a row, it's been a toss-up. So 1 week later, the percentage change on the S&P 500, these are all the occasions that we've been down 5 weeks in a row. We haven't had a down 5 week in a row period since 2011. But this one stops at 2008. So this is the first one since 2011. As we can see, the 6th week right here, 45% chance that we're positive. 7th week, 50% chance. Now we may, fluctuate. We may, find ourselves in positive territory at some point this week or that week, but generally we end the week with still further declines. And this goes out 10 weeks, folks. I can't get a win percentage or a positive percentage rate above 50% after we've had a 5 week down week in a row. The best is 50% probabilities. It's a coin flip out 10 weeks, which again tells you like something, something's being discounted persistently and egregiously in the market. Now that's just 10 weeks. Okay. So this study goes out 10 weeks from quantifiable edges. If we look further than 10 weeks, if we're out 26 weeks, here's the 10 to 15 week mark right here, which suggests, you do have a bounce of sorts, but it's mostly sideways action, taking you, right back into the lows of this corrective wave. And you do a goodly amount of trading sideways from the 14 week to the 24 week point, and then it's nicely higher. Everything from the 26 week period out to 52 weeks is significantly higher, double-digit gains, which suggest, again, near-term problems. But we're going to find a base also in the interim. And when you look out 26 to 52 weeks, so 6 months to 12 months, the market is generally delivering a double-digit return post this 5 week correction. So good study there. Why does it feel so bad out there? Because as we said, it seems to be a buyer strike. Every rally sold into, and even the rallies are probably just short covering. And when that short covering dissipates, there's nothing underneath, that there's no bid underneath there, hence the buyer strike. This is the worst performance through 90 trading days. This is the worst performance going back to 1932. Yeah, 1932 after 90 trading days. And this is from Charlie Bilello. We had a 26% decline. As of yesterday's close, down 17.4%. Can it get worse? Clearly, this is the 91st trading day to the year end. And you can see, fell another 8% here in 1941. A little bit further to the downside here. A lot more downside in 2002. 1973, 10% lower. When you see this data and you think about where you are right now in your portfolios, that's the question you should be asking yourself. Basically, can I stomach this? This is obvious. So you're already down 17%. Another 1.8% isn't going to kill anybody. 16.6% though, this was basically the end of the .com bust period. So this helps you with planning also. Maybe we go down another 5%. You have cash on the sidelines. Maybe you allocate. 5% more takes you down 10%. Maybe you allocate some more. Another 5%, you're down another, 15% from where we are here. Man, that would be 32% if my math is correct. 17.4% year-to-date decline plus another possible, let's say 15% is 32%. We are basically right back That was the decline from March 2020. I doubt that's going to be the outcome. That would be recessionary. I would be of the opinion that's recessionary. We also have that data so far as, is the market pricing in a recession? We have that data here in the weekly state of the market as well. Scroll on for now. Now, this looks like, it feels like a really bad correction. These are all the corrections since World War II, but right now it's about average. The average correction going all the way back to 1946 is about 14%. There's, some in here that are 19, some that are 16. So right now it is still just a correction. It feels much worse, but it's still just a correction in the S&P 500. Something else that's taking place this year is that it's a decennial year. Some of you remember, what this chart looks like. Decennial years tend to be poor. They tend to encapsulate midterm election cycle years as well. But 1952, 62, 72, 82, 92, 2002, 2012, the average performance was just like this. Really bad first half of the year. And then the second half of the year just took off. And this almost looks just like the midterm election years also, where the average decline in a midterm year is 17%. Well, we did that. We're doing a little bit more as of today, I think. Yeah, we certainly are. Down below 3,900 here on the S&P. NASDAQ's down another 200 points. But again, this is the typical midterm year, the typical decennial year so far in the S&P 500. And why do we talk about thinking longer term? Because good stuff tends to happen at the end of a midterm year and the first 2 quarters of the new year, which would be 2023. The S&P has averaged an intra-year pullback of 17% in midterm election years going all the way back to the 1920s. The last 3 months of a midterm year and the first 2 quarters, so basically 3 quarters of the following year, is highly bullish. The average return, so October, November, December, January, February, March, April, May, June, the average return after a midterm election cycle is 32.3%. That's not a little rebound, folks. That is a big rebound.
Certainly looking forward to that.
Yes, I think we all are. Did you have any other questions you might want to interject with here, Hernan?
No, I think we are on the verge of getting to a technical bear market as of today. I think we are almost there.
Yeah, I think we're down now 18.5, almost 19%. But yeah, perfect time to remind me of that. This chart right here is the S&P 500. The bear market would be achieved at 38.55. So that would be, where are we now? Yeah, we might have tagged it actually. Almost 38.61. 38, so we're 7 points away from it right now. Not looking good for another state of the market Thursday, folks. 38.2% retracement from the March 2020 low to the January 2020 high. The 38.2 Fibonacci retracement level would come in just slightly below a technical bear market at 38.15. But yeah, as you said, it feels like the market has an agenda. Algorithms know where these levels are. They're coded to them. And they may not terminate. Algorithms have a life cycle. They terminate when they've basically done their job. And that seems like a job that they want to complete here, possibly today, the bear market, and possibly this week, the 38.2 Fibonacci retracement level. We talked a lot about Fibonacci retracements and downside probabilities in our weekly research report. Unfortunately, a lot of them have come to fruition. But in talking about them and studying them, we can set our expectations and adjust our game plans for capital allocate, for the buying of the dip in our long-term portfolios. Yesterday was a little odd because we had the S&P 500 down 1%, 1.5%. But while the S&P 500 was down 1.5%, the VIX was also down on the day by a little more than 1%. And these are all the occasions that it's happened before. It doesn't happen very frequently. And this data goes back to 2000. Why don't we go back to 1990? It never happened before 1990. S&P 500 down 1.5%, VIX also down, because that's a big decline. 1.5% on the S&P 500 and the VIX was down. And if you can tell by the dates that these were mostly bear markets, shy of 2016 and 2018. This kind of price action and relationship between the S&P 500 and VIX generally only happened in bear markets. But 1 week later, these are the returns, and they're largely positive. This was a decline here 1 week later in 2009. This was a decline 9% 1 week later, which tells you you're still in the throes of that bear market. 2008, small decline. 2002, 5%. But most occurrences were positive. Most occurrences. All right, we talked a lot about breadth. Market breadth has been atrocious. The market has halitosis. It's got the dragon. For those of you who grew up in the 1980s, you might have remembered Bismarcky. You got the dragon song. It was a pretty good rap song, although most people remember Bismarcky for, what was it? You got what I need, but you say, okay, I won't rap here, even though Bismarcky didn't do a good job of rapping. Anyway, so let's get back to it. This breadth study, the selling pressure has been intense the last few weeks. 6 out of 12 days, we've had 80% declining issues in the S&P 500. And this study offers the 63-day returns in the times in the past that we've had, breadth this bad, this persistently. It's happened 39 times in the past. Indications of a washout within a bottoming process is basically why breadth has been so bad. We talked a lot about bottoming processes in our weekly research report, keeping in mind that just as topping is a process, so is bottoming. It's great when you're topping and you can rebalance your portfolio. It feels good. The market's giving you some time. It feels terrible when you're having a bottoming process because prices continue to go lower. But, if you're a long-term investor, it should be delightful as you're given the opportunity to allocate at cheaper prices. So anyways, with respect to 6 out of 12 days, we've had 80 declining issues. 80% of stocks are going down 6 out of 12 days. Going forward 3 months, which in this study, 63 days is about 3 trading months. Similar historic events have had returns, positive returns 82% of the time, with average gain of 10.5%. There were drawdowns in this period, folks. So we don't just go straight up. There could still be declines over the 63 days, but ultimately by the end of the 63 days, the market had pretty nice returns, about 10.5%. The forward drawdown average, so if you're thinking about further downside from here, within this 63-day period, the average drawdown was 4.8% to basically capture that 10.5% return. So bad breath, but things get better. You need this washout, this cleansing period. This is the same study, again, performed by Jonathan Harrier, but this goes out 252 days. So essentially, a full calendar year of returns. So we looked at the 3-month and we looked at the full year. And from this study, 97% of the time, a year later, you had positive returns. The average return a year later is 29%. So it's just like going through the COVID crash. You know, you had to endure that to get to the other side. And at the other side of the COVID crash was very strong returns, you know, basically from April 1st to January 1st of 2022. We had a long runway to the upside. Things are bad right now, but they generally get better looking out a year. Similar study here, S&P 500 after 2 out of the 3 days where we had less than 7% of the NYSE up volume. This study from Sentiment Trader, if we look at the NYSE breadth in an even narrower environment, which has recently occurred, we find that there is liquidation taking place. That's what all this downside pressure is, folks. We have liquidations. Everybody's deleveraging. Nobody's buying, or not enough people are buying, obviously. But this is liquidation. This is that deleveraging. This is that capitulatory phase, which takes place in the bottoming process. Over the past 60 years, there have been 12 times, other than, you know, this time that just happened this week, when 2 out of 3 sessions saw 93% or more of volume focused on falling stocks. So most of the volume is to the downside. Of the 12 times that this has happened in the past, going all the way back to the 60s, 11 of them witnessed a rebound. So it's a matter of breadth is so bad, can we get a breadth thrust from here to the upside? So this is just about a rebound, and as you can see, 3 months later, the returns are all positive. All positive. And this, 23.8%, 29% in this study, I mean, they're all in that same general area, which again tells you how much are you down year to date. Now think about if these are the average returns based on the breadth studies that we're showing here, would you be back to even? Or what if you started, your game plan, executing your game plan? Because if you're just buy and hold and not doing anything else over the next year, you're going to do as well as the market. No better, no worse. But if you start allocating, then it may not even take you 6 months to get back to the even mark, as the market should rebound over the next six months to 1 year period. How do we know that folks are deleveraging? Well, that's what the data tells us. The aggregate fund flows. Look at this, folks. We've only seen aggregate fund flows this poor during the March 2020 crash, back here in late 2019, and the 2018 Q4 period. So yeah, everybody's been deleveraging. This is looking at hedge fund positioning. I mean, look what hedge funds are doing. They're deleveraging. We can see this in the NIME exposure index. The NIME exposure index provides insight into the actual adjustment active risk managers or active portfolio managers have made to client accounts over the past 2 weeks. Look at the deleveraging. This is actually the lowest reading for the NIME. This is the lowest reading since March 2020. So yeah, the data says they're deleveraging. Yeah. Again, this is part of that bottoming process. Liquidation, forced selling. There's no data that says anybody's forced to sell, but I guess if you look at some of the big dollar stocks, you look at your Apples and Microsofts, which have been the last to get hit really hard. Apple dropping below $140 today, and it lost 5% yesterday. That tells you that everything that everybody owns, if they're getting margin calls, they have to start selling to satisfy those margin calls. The most widely held stock in global portfolios is Apple. So it's kind of the last general to fall, if you will. Make sense, Hernan?
It does. And I was looking at the deleveraging from active portfolio manager, and I think that could be one of the things that could fuel the rally by year end. Because they will need to catch up eventually.
Yeah, everybody's been so focused on the downside risk. It kind of flips the tables to where eventually the risk is going to be to the upside. So, they deleverage this much. At some point, the market is going to figure that it's priced in higher rates. It's priced in maybe an economic slowdown. It's priced in maybe earnings get adjusted or revised lower a bit here this year. It's adjusted to the China lockdowns, adjusted to all of these different things, and it's going to say, okay, well, from here it can only get better. So now we're going to start pricing in, better earnings out 9, 12, 15 months from here, since we're down to 3,800 as opposed to 4,700 on the first trading day of the year, for sure. One of the things that we pointed out in the Finom Group Weekly Research Report was the fact that if you go all the way back, the turn of the century, because the data just goes back to 2004, but since 2004, every single market bottom, so every market bottom this century has occurred with a 5-day moving average of the equity-only put-call ratio achieving 75 or higher. And you can see the dates here and circled here. Every time it goes 75 is where we have the line here. And every time we've made a bottom, the equity-only put-call ratio, 5-day moving average of the put-call ratio has to be 75 or better. Every single market bottom. So yesterday we got to 73. We got to 73 on the 5-day moving average of the put-call ratio, suggesting we are that close. We came into the week at 65 or 62. We came into the week at 62 or 63 on the 5-day moving average of the equity put-call ratio. Now, as of yesterday's close, it's at 73. I would imagine with the declines that we're seeing here today still yet, we're probably going to hit that 0.75 level here, today. Which, again, we're looking for bottoming signals that are consistent with history. So hopefully that comes true. Here was the reading as of yesterday, folks. Yesterday's close. It only updates end of day. And there it is, 0.73, 0.02 points away. So, and why do we keep saying you should have a game plan? Yes, you should be weighing into this damage, why you should be buying the dip and thinking long-term. And people have said, well, the Fed put is no longer here. Or, what do you, with the Fed and everybody, what's going to get this market going? I've heard a lot about, do you have anything? Is that something that you're kind of worried about there, Hernan? Like what exactly is going to get the market?
Yeah, exactly. That was one of my questions, because in one hand, on the technical side, there are plenty of oversold readings in different metrics, studies, but that has been the case for many days now, and we continue going down. So it's kind of what would take for this market to stop going down and restart the uptrend. And then in parallel to that, was another side of this same question is, I have seen that in December 2018 drop, it found its bottom after the Fed changed to a more dovish tone and stopped the autopilot. COVID crash found its bottom when the Fed started the more accommodative monetary policy. So I was wondering whether, do you think a change in the Fed tone or actions is a necessary condition for this market to change trends?
It would help. I'm not going to lie and say, it wouldn't help. I think it would help. But I hesitate to say it's necessary. I think that because we've been in this quantitative easing era, whether it's domestically or globally, global central banks, we just kind of think that the price action is solely correlated to monetary policy. In short cycles, it can look like that, but over the long term, it's not the case. So I don't think it's necessary. It would be helpful if they had a more conciliatory or accommodative message first. And that may be actually happening. But in terms of, if we look at the actual data, let's go back to the 1960s, as you can see in this graph here. If we go back to the 1960s, so from 1960 to 1969, the S&P 500 delivered an annualized return of 10.7%. What about the inflationary period in the bear market period of the 1970s? And this is without the Fed lifting a finger. This is without the Fed firing any bullets, if you will. Although we had turbulent markets, the annualized return from the 1970 to 1979 was still 6.2%. So it wasn't as robust, of course, as the 70s, which was not the inflationary period that the 60s was not the inflationary period that the 70s were, but you still had, pretty good gains here. We can't get this in our savings account. We can't get 6.2% annualized, from a T-bill. So, and then here's after the 1980s. After the 1980s, double digits. That includes the 90s. That includes 2000s, 2010s, up to today. So with or without the Fed, the market still, in general, delivers a double-digit return annually. So that's why I say I don't think the Fed has to. It's not the number one requirement. It's an added boost because the market's going to follow earnings. Right now, to your earlier question, market is doubtful of those earnings because of all the macroeconomic issues that we talked about. But this is why you stick with the market, regardless. Fed this, Fed that. They're helpful, but they're not the number one input, if you will. So, all right, we've talked a goodly amount about the S&P 500, and here's the NASDAQ. This is from our weekly research report. And what we identified here was the fact that the NASDAQ had tested, this is the NASDAQ composite, it had tested, the 38.2 Fibonacci retracement a couple times, and the third time it broke down. We don't like that. It could have been seen as a false breakdown, but price action proved it was not a false breakdown as we just continued lower. So within our weekly research report, where's the next Fibonacci level? The 50% retracement comes in at 11,400. We were down 5 weeks in a row. We know that the data is not good for week number 6. The probabilities aren't terribly favorable. So our instinct was that more than likely this 50% Fibonacci retracement was going to get tested in the 11,400s. It was yesterday. It closed below that level. So we have still yet to find support. We wanted to also tie some numbers to these levels that we keep falling. So we knew that at the 50% Fibonacci level, the NASDAQ would be down 29%. Again, this is all about planning and just recognizing the probabilities and being able to say to yourself, if in my portfolio, if the NASDAQ goes down and I'm levered to the NASDAQ, we go down another 5%, which we have done already this week, where's my portfolio going to be? How much cash do I have on the sidelines? That's one of the reasons why you plan ahead. You look at these technicals and you look at the probabilities. And so NASDAQ at the close yesterday down 30% from its all-time highs hit in November of 2021. These are all the bear markets in the NASDAQ ever. So the NASDAQ, 1971, came to market. First bear market for the NASDAQ was in 1973. And so what we're looking at when we review the NASDAQ bear markets, the average bear market is a 35% correction in the NASDAQ. So again, we knew there was a probability if we broke these Fibonacci levels, we'd be down 29%. So from there, we want to know, what are the probabilities that we're in a bear market? What is the average bear market for the NASDAQ? Well, it's 35%. So indeed, if this is going to be the average bear market, we should anticipate another 5% decline from here. Now, the average bear market, the number of days to get that average decline is 198. This NASDAQ bear market is 170 days old as of today. So it's happening very fast, this bear market. Essentially, we got a little bit more than a month, so far as meeting the average bear market days. It could be a quicker one, like, if you take out the highs and the lows and the longest duration and the shortest duration. The median bear market is only 120 days. The median bear market is 32%, which we've achieved today, that 32% mark. Not on a closing basis, obviously. We'll see where we're at in a little bit. Why has it felt so bad? Because in the NASDAQ, with the NASDAQ's correction, because we have had the biggest decline in the NASDAQ so far as indexes are concerned. But look at the 5-day rate of change in the NASDAQ. This chart by Bespoke Investment Group, 5 trading sessions. The NASDAQ was down 12.39%. This generally doesn't happen outside of some type of crashy markets. It happened in 2008. There's the dot-com bubble. Here's 1987 crash. And here was that 2018 23% bear market for the NASDAQ. So feels bad because it's happening really quickly. Here's 5 weeks down in a row for the NASDAQ. Since we looked at 5 weeks down in a row for the S&P 500, folks, not much difference. 5 weeks down, that's the top line. Usually we do actually get a bounce, flatten out, so we don't get a whole lot of sustained upward bias. And then we're basically, back to the lows and trading sideways for, a goodly amount of time. So there's not a lot of positive bias to the upside, even after a NASDAQ 5-week loss. But with that 5-week loss, as we continue to update what the insiders are doing, Hernan, the insiders are still buying the NASDAQ 100. I mean, they're still at very lofty levels. Either they're intelligent dip buyers thinking long-term, or, they're, just crazy. I don't know. They're hodlers. I don't know. They're diamond hands. I don't know what to tell you. But the forward returns are, they're generally, we have 80%, 90%. This is out 2 months and 3 months, 6 months, 1 year. 82% obviously is not 93%, but these are high win rates here. So the insiders are buying. They were buying in March of 2020 also. I think that should also be recognized here. Here was 2020. They weren't buying as well. I'm sorry. Yeah, there it is right there. They were buying. Here, 2016 bear market for the NASDAQ. They were buying 2001, 2002. So they're looking for cheap shares, long-term holdings. And that's how you got to think about these things, long-term. All right, like I said before, we got a lot of good data here so far. Is the market pricing in a recession? I invite all of our Finom group members to read through it. We're going to check this out live in the trading room tomorrow. But if you want to know where the market could go based on earnings per share, like if we're pricing in a recession, The average recession has a percentage decline in earnings of about 26%. If we look from the 1990s, the 2000 and 2020 recessions, the average earnings decline is 26%. And so we've got all that data here, including what the PE at different PE levels. So do check that out. So far as Merrill Lynch is concerned, they still don't see a recession based on their indicators. They look at housing starts, unemployment claims, industrial production, and vehicle sales. And it's all the way down here, their recession indicator. They still don't see it. Here was a tweet I really liked from Mark Zandi. Having said this, it's worth remembering the old Paul. This was the one I was trying to get out earlier. The old Paul Samuelson quip that the stock market has predicted 9 of the past 5 recessions. That is, stock prices often fall, but a recession does not necessarily follow. There's a lot of reasons why investors sell, other than just fear of a recession. All right, so that's all we got for the weekly state of the market. But Hernan, if you have any more questions, now's the time. I'll do my version of Jim Cramer's lightning round.
Perfect. I have two. One more on the market, and the other is a little more personal for you.
Okay.
So the first one is on the market. Is valuation multiples have changed drastically since last year, especially for growth stocks. So how long do you estimate that FanMag, or at least the strongest among them, like Apple, Microsoft, Google, will take to go back to former multiples? And how long for the rest of the companies?
Well, if a lot of this derating is about the strength of that earnings growth and whether or not there is going to be earnings growth. So companies have to prove themselves, which is why recoveries are generally not V-shaped. I say that hesitantly because that is all we've seen since 2016 is basically V-shaped recoveries. But generally, it's a slower process to get going again because investors want to see multiple quarters of rejuvenation, if you will. They all, the multiples are also a byproduct of interest rates. So as part of the derating of the multiple has been a byproduct of rates are going higher, so the equity risk premium gravitates lower. Typically, price to earnings multiples contract in rising rate environments. So we need two things. We need rates to stabilize. I mean, even though they're at elevated levels compared to the last couple of years, they're still not high historically. The 10-year yield at 3% is not high historically. In the 90s, it was 7, 8, 9%. In the 80s, it was double digits. So a yield at 3% is only high if you compare it to the 2009 to 2020 period. So we need yields to stabilize. We need rates to stabilize. And I think, just solid quarterly earnings, and you'll see the PE start to grow again.
Perfect, thank you. And then on a more personal note, I have made many mistakes during this year, and I'm learning a lot. I have learned a lot from those mistakes and from the Finom group and from you. But you are a very experienced portfolio manager that has went through many crashes, different market conditions. So what have you learned specifically from this one?
Well, from this one, it's not over yet, but I would say I've learned that my process has improved. Part of my process, my overall investing process, also surrounds having price objectives, having return objectives, profit objectives in mind, sticking to them, and having quarterly rebalancing, within my process, so I'm able to lock in profits as well as raise cash. and just, the general planning ahead works. Experienced investors that have gone through many market declines, corrections, or bear markets, they have battle scars. We all have battle scars as investors. So yeah, it's a great question. You learn something every time. What I learned during the COVID crash, and what I emphasized for our members, was not to look away. It pays to be optimistic. Pessimists don't get paid, because they're never looking at the glass as half full, which is the upside in the market that will eventually be realized. So just staying positive this time around is something that I'm reinforcing, and just taking the losses. I'm someone who needs to be actively engaged, doing daily trades. But during this cycle, because it's more nuanced, we have a tightening cycle that we're derating the market into. So I'm still trading, but I have what I call win, lose, or draw trades, and I stick to them. So if it doesn't work out on the day, I'll take my loss. Rather than in a downtrend, holding for too long and then it becomes a bigger loss. It's one thing to hold overnight, hold over a week when you're in an uptrend. When you're in a downtrend and you have a buyer strike, it's the opposite. It's never a good idea to extend a trade. It was supposed to be a trade. It's never good to extend it further than the plan. So sticking to the discipline, I've learned that's definitely worked for me here in this downtrend environment. But we all make mistakes, that even though I've got wins, through this derating cycle and through this bear market now, I've got opportunities. I'm recognizing I still have opportunities, no matter how much experience. Like, people have been saying, well, the traders nowadays, they haven't been through, or the investors nowadays, they haven't been through, this kind of environment before. And I want to say, when was the last time you went through a global pandemic shutdown? When was the last time you went through a 9/11 or a dot-com bubble? Like, every single time is different. So when people say, oh, they haven't been through this kind of market, the market environment is always different, and corrections are always happening for different reasons. So it's kind of a nonsensical statement for somebody to say, well, they don't know, they haven't been through this type of environment. Stop, So I stay away from that kind of stuff. So, great questions. Thank you.
Thank you. Thank you.
All right, folks, I think that's a wrap here for our weekly State of the Market. Hopefully we'll be in for some better times. Keep an eye on these studies. If you're not a Finom Group member, come to phenomgroup.com, register, get access to our weekly research report, and immediate access to our weekly State of the Market. Safe trading, everybody. We'll see you next time.